This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on the Federal Reserve's monetary policy objectives. We'll be diving into the specifics of how the Fed aims to manage the U.S. economy.
The Fed's role is crucial for maintaining economic stability, and understanding their objectives is key to understanding the broader economic landscape.
Precisely. It's not always easy to grasp, but it's vital. What's the core mandate, in your view?
At its heart, the Fed strives for maximum employment, stable prices, and moderate long-term interest rates. A delicate balancing act, to say the least.
A balancing act indeed. Let's unpack how these three goals interact and sometimes conflict. Let's start with maximum employment. How does the Fed define and pursue this goal?
Maximum employment doesn't mean zero unemployment. It's about achieving a level of employment consistent with the economy's potential, considering factors like labor force participation and productivity. The Fed uses various economic indicators, like the unemployment rate and job growth figures, to assess progress.
So it's not just about a number, but a holistic view of the labor market.
Exactly. They also consider things like wage growth, which can signal inflationary pressures if it's too rapid.
Now let's move to stable prices. How does the Fed measure and target price stability?
The Fed primarily focuses on the inflation rate, typically measured by the Consumer Price Index, CPI, or the Personal Consumption Expenditures, PCE Index. Their target is usually around 2%, reflecting a balance between price stability and economic growth. Too much inflation erodes purchasing power, while too little can stifle economic activity.
And what tools does the Fed employ to control inflation?
The primary tool is adjusting the federal funds rate, influencing borrowing costs across the economy. They also use quantitative easing or quantitative tightening, buying or selling government bonds to influence the money supply.
Let's discuss moderate long-term interest rates. How do these fit into the overall picture?
Moderate long-term interest rates are important for several reasons. They encourage investment and borrowing, supporting economic growth. High interest rates can curb inflation, but also slow down economic activity. The Fed aims for a rate that supports sustainable growth without fueling excessive inflation.
So it's about finding the sweet spot that promotes both growth and stability.
Precisely. It's a constant calibration based on economic data and forecasts.
Given these three objectives, how does the Fed navigate potential conflicts between them?
The Fed acknowledges that these goals can sometimes conflict. For example, policies aimed at boosting employment might lead to higher inflation. The Fed's challenge is to find the optimal balance, considering the current economic conditions and the potential trade-offs.
And how does the Fed communicate its policy decisions and objectives to the public?
Transparency is crucial. The Fed regularly publishes economic data, releases statements after its meetings, and holds press conferences to explain its decisions and outlook. This helps manage expectations and maintain market confidence.
The FOMC plays a central role in monetary policy. Can you explain its function?
The FOMC is the key decision-making body within the Federal Reserve System. It sets the federal funds rate target and oversees open market operations, influencing the money supply and credit conditions. Its members include the 7 governors of the Federal Reserve Board and 5 Reserve Bank presidents.
So it's a collaborative effort between the Board of Governors and the regional reserve banks.
Exactly. This structure ensures a balance between national and regional perspectives on economic conditions.
The text mentions long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production. Can you elaborate?
This emphasizes the Fed's focus on sustainable, long-term economic growth. They aim to manage the money supply and credit conditions to support this growth without triggering excessive inflation or financial instability. It's about fostering a healthy and stable economic environment over the long term.
So it's not just about short-term fixes, but a long-term vision for the economy.
Absolutely. Short-term adjustments are made, but the overarching goal is sustainable, long-term growth.
The Fed's actions are not without criticism. What are some of the challenges and criticisms it faces?
The Fed faces criticism for its effectiveness in achieving its goals, particularly during periods of economic uncertainty or crisis. Some argue that its policies are too slow to react to changing economic conditions, while others criticize its transparency and communication. There are also debates about the appropriate level of inflation targeting and the effectiveness of its various policy tools.
And how does the Fed respond to these criticisms?
The Fed continually reviews its policies and procedures, adapting its approach based on economic data and lessons learned from past experiences. It also strives to improve its communication and transparency to better explain its actions and objectives to the public.
Why is it important for the public to understand the Fed's monetary policy objectives?
Understanding the Fed's objectives helps individuals and businesses make informed decisions. It allows them to better anticipate economic trends, manage their finances, and participate effectively in the economy. It also fosters greater accountability and public trust in the central bank's actions.
So it's about empowering citizens to navigate the economic landscape.
Precisely. Informed citizens are better equipped to participate in and contribute to a healthy economy.
Looking ahead, what are some of the key challenges and opportunities facing the Fed in pursuing its monetary policy objectives?
The Fed faces ongoing challenges in managing inflation, particularly in a globalized economy with interconnected financial markets. Technological advancements and evolving economic structures also present both challenges and opportunities. The Fed must adapt its policies and tools to address these changes effectively.
And how might the Fed adapt to these challenges?
The Fed will likely continue to refine its models and forecasting techniques, incorporating new data and insights. It will also need to enhance its communication and transparency to maintain public trust and manage expectations effectively. Collaboration with other central banks and international organizations will also be crucial.
What is the role of Congress in overseeing the Federal Reserve?
Congress plays a crucial oversight role, holding hearings, reviewing the Fed's performance, and shaping the legal framework within which the Fed operates. This ensures accountability and helps maintain public trust in the central bank's actions.
So it's a system of checks and balances.
Exactly. This balance of power is essential for a healthy and effective monetary policy system.
Let's briefly summarize the key takeaways. The Fed's primary goals are maximum employment, stable prices, and moderate long-term interest rates. These goals are interconnected and sometimes conflicting, requiring careful balancing.
The FOMC plays a central role in decision-making, and the Fed uses various tools to influence the economy. Transparency and communication are crucial for maintaining public trust and managing expectations. The Fed faces ongoing challenges, but it continually adapts its approach to meet these challenges effectively.
And understanding the Fed's objectives is crucial for individuals, businesses, and policymakers alike. This discussion has provided a comprehensive overview of the Federal Reserve's monetary policy objectives. It's a complex but vital area of economic policy.
Indeed. The Fed's actions have a profound impact on the lives of all Americans.
That was a great discussion. Thank you for your insights.